Welcome to the Candlestick Forum Hammer Signal Training Program. My name is Steve Bigelow. I've got over 35 years of an investment experience, 25 of which have been oriented toward candlestick analysis. I've written 3 books on how the candlestick signals work, what are the most effective signals, and how to mentally put yourself in control when using candlestick signals. What I discovered over the last 25 years is out of the 50 or 60 signals that are available in candlestick analysis, there's only 12 that you need to learn. And if you understand the psychology and recognize where those signals work, you now can master your own trading and not rely on anybody else to make decisions for you. Today's trading is going to be involving the candlestick signal, the hammer. This is one of the 12 major signals, and it's got very simple applications. As you may have seen in some of the other training programs, there's only one formula that you have to know in candlestick analysis, and that's the number 2. In the case of the hammer signal, the tail or the lower shadow will be 2 times greater than the body. Now the body can either be bullish, white, or bearish. The main factor of a hammer signal is a tail 2 times greater than the body, and it's usually going to be found at the end of a downtrend. The one most compelling asset or aspect of a hammer is that tail pushing to the downside. Basically tells you that the bears have hammered out the bottom before the bulls stepped in. If you see a downtrend and then you start seeing that proverbial panic selling at the bottom, start looking for a candlestick buy signal. A hammer is basically where all the sellers are coming out. Finally, when they're done selling, the bulls step in and start taking it back up, and it will usually occur when your stochastics are down here in the oversold condition. And as with most candlestick signals, once a hammer is formed, especially in the oversold area at the bottom of a downtrend, what do we want to see the next day? We want to see the bulls are there, bullish confirmation. And that's any positive trading the following day. And a hammer signal is predominantly with the body at the top end of the trading range. However, if there is a slight shadow above the body, that doesn't deter from the fact that the big shadow to the downside still indicates that the bears were knocking it down before the bulls stepped back in. As mentioned earlier, hammers require confirmation to show that the bulls have stepped in after the signal. As illustrated in this chart, you had a big hammer or shadow to the downside, a hammer type formation, stochastics closer to the oversold area. Basically what we're looking for the next day is positive trading. The probabilities are extremely strong, and we stress the word probabilities. Nothing's set in stone, but remember, these signals would not be conveyed to us or expressed to us by the Japanese rice traders as reversals if they didn't work on a high probability, a high degree of probability that the reversal has occurred. That long shadow to the downside is basically where the bears have hammered out the bottom and the bulls have stepped back in. And as demonstrated in this chart, after an excessive downtrend, stochastics in the oversold area, we have a hammer signal followed by another hammer signal. And the ultimate hammer signal, obviously, is a dragonfly doji, where they open it at the top, take it down, and close it right back at the top. So you have a doji hammer, and then what do we want to see the next day? We want to see bullish confirmation. The gap up, which we'll go into much more detail, is the strongest of that confirmation. Remember, If you studied the doji, the best friend is a doji followed by a gap up. That's always going to, not always, but it's going to produce a high probability, high profit trade. Each reversal signal does not have to be a standalone signal. As we can see in this chart, we had a little spinning top doji in the oversold area, followed by a hammer signal. Again, that tail to the downside should be the neon sign that tells you there's been a change of investor sentiment. What should we be looking for the next day? A positive open. And as with most candlestick signals, they don't necessarily have to go straight up from the signal. As we can see in this case, we had another bullish day followed by a little gap up the second day after the hammer signal. Basically, this is telling us there's a change of investor sentiment. It doesn't have to start right off. It can be a day or two before things start up. This just tells you there's probably a change of investor sentiment. You want to start watching for bullish confirmation. And this becomes more credible when you see the stochastics down in the oversold condition. One of the most beneficial aspects of candlestick analysis, the Japanese rice traders created the box in of the open and the close, and it gave you a good, or gives you a good graphic reference to what's going on in investor sentiment. Where do most people sell? They usually panic sell at the bottom. So in this case, we have a gap down at the bottom of a downtrend before we see a hammer signal that tells us the selling probably has stopped. Say probably has stopped. What do we want to see the next day? We want to see that the bulls have started coming back in after that signal. This is a case also of where do you buy a fallen, or where do you grab for that fallen knife? That's what candlestick analysis does for us, is it creates the signals that tells us with a high probability when investor sentiment has changed and it's time to be buying. One of the important aspects of candlestick analysis is that it shows when everything else is dismal where the smart money is starting to buy. Back in the old days before candlesticks came along, I was always the one selling down here, and as soon as I would sell, it would start back up, and I kept asking myself, how the heck do I know when to sell at the bottom, and who are the people buying down here? Even though the news is terrible, the outlook is terrible, somebody is buying down here, and it's usually the smart money. This has changed, or should change, your whole perception of when to be buying and selling. It is very difficult emotionally to be buying when everybody else is selling. But if we have the benefit of knowing that we're in an oversold condition and we start seeing a high probability reversal signal, that puts us in a position to be buying with the smart money at the bottom instead of selling. Candlestick graphics provide all sorts of alerts to tell us when it's time to be buying. In this case, that big down day with stochastics near the oversold area, start watching for a buy signal. Also, as with all the other candlestick signals, the further you move away from the T-line, and I'll refresh everybody's memory, the moving averages that we have on these charts is the 200-day simple moving average, the 50-day simple moving average, and this gray line is the 20-day simple moving average. The reason we have those moving averages on the charts is that every major money manager around the world uses those moving averages to make their decisions about their portfolios. The benefit we have with candlestick signals is we can see immediately what is going on in investor sentiment, especially when it hits some of these levels either as support or resistance. The most important one on the chart is this black line, which we call the T-line. This is the 8 exponential moving average. Very simple. If you see a candlestick buy signal and a close above the T-line, you can stay in that trend until you see a candlestick sell signal and a close back below that T-line. With one caveat. The further you move away from the T-line, the higher the probability it's going to move back up to the T-line. This makes it very easy that if you see a candlestick buy signal in the oversold condition a good distance away from the T-line, you know at least your first entry strategy is to come up and see what it's going to do at the T-line. Even if it fails at the T-line, which means you're still in a downtrend, you can still be getting out of a position, either break even or maybe with a positive result. Again, the ultimate doji or hammer signal is that dragonfly doji, but the telling aspect of a reversal using the hammer signal is that tail to the downside. The bears tried to knock it down, the bulls have brought it back up. Then what do we want to see? We want to see bullish confirmation. In this case, a gap up is good confirmation, number one. And number two, a close above the T-line is also good confirmation. The more elements we can put into a reversal signal analysis as to why the bulls are taking control, the higher the probability that we are in an uptrend. And to analyze a strong reversal, use the combination of other signals. Notice the doji followed by a hammer signal. Not only was this a hammer signal, but this was a bullish engulfing signal compared to the doji. This puts you with a left-right combination with a hammer. What do we want to see the next day? Positive open. That's going to start your strong uptrend. The hammer signal can be a part of a signal or stand alone. And keep in mind that a reversal doesn't have to start right away. Notice the hammer doji, indecisive trading, bobbing around, but then the next big hammer signal with bullish confirmation kept you up above the T-line, starting the uptrend. This all indicates that the bulls are starting to step in here. It's just waiting for that when they get the bullish confirmation and get the uptrend going. A strong indication, a big hammer signal. The bigger the signal, the higher the probability they're going to reverse it. Plus, the distance they are away from the T-line means any bullish confirmation you can be buying, because your first resistance potential is up here at the T-line. That may still produce a decent little profit even if it comes up here and fails. But the fact that we see a strong buy signal in an oversold condition away from the T-line, the good probability is that's where the uptrend has started. We will see it go through the T-line and continue higher until it closes back below the T-line. And we will look at in depth where a hammer signal can occur. Notice we're right about at the 50-day moving average, and they start back up again, so it looks like the 50 days acting as support, number one. Number two, looks like we're doing a double bottom. See a hammer signal right at the same level we saw buy signals, or a doji buy signal potential a few weeks earlier. Bullish confirmation, doubtful the next day, but what's our rule of a doji? It's going to move in the direction of how they open it after a doji. So this whole complex right here pretty much shows us there's a very high probability this trend is reversed. Doji, bullish open right after a hammer signal, a close above the T-line and the 50. Stochastics coming up, all the elements that you're going to be in an uptrend. Another little element that makes a reversal more compelling is notice how on our spinning top and then the hammer signal, they basically reversed right at the same level. This is an added confirmation that there's support down here. Somebody's buying at those levels. That's more evidence that they're going to be in a strong uptrend. So scanning for a strong reversal not only includes looking for the signal itself, but how it performs after the signal. Once again, a good distance away from the T-line, bullish confirmation, followed by a gap up that closes above the T-line, produces an extremely high probability that you're in an uptrend. So with any candlestick signal, especially the hammer, A gap down and at the end of a downtrend is a very strong alert that the panic selling has occurred, the sellers are out of the market, the bulls have stepped in. Where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. So if we start seeing gap downs and we're near the oversold area, start looking for a candlestick buy signal. Especially if that selling picks up speed enough that it's moving the price away from the T-line. This is strong bullish confirmation that that if you see a hammer signal that far away from the T-line and you start seeing the trade positive the next day, we know at least our first target is up here at the T-line. You want to be buying for two reasons. Number one, it gives us the advantage of getting in after a candlestick buy signal immediately. This does two things. Most trading techniques usually require some confirmation, and their confirmation may be that a trend needs to move positive 2, 3, 4 days before it can be considered a trend reversal. Candlestick analysis has the benefit of not having to wait at all. All you need to do is see a candlestick reversal signal and the bullish confirmation. You can be buying immediately, which does two things. One, it puts you into a position early that other people are going to be buying when it confirms for them further on up, producing better profits for you. And two, you're getting in early enough that if it turns around and does something that it shouldn't do, like trade back below the head of the hammer signal, you get out immediately. Candlestick analysis has the benefit of telling you when to get into a position and when to get out of a position. I've been in the business for 35 years and I've heard numerous professional money managers tell you to cut your losses short and let your profits run. Unfortunately, in 35 years, I've never had one of them tell you how you cut your losses short and let your profits run. Candlestick analysis has very simple rules. If this is a reversal signal and we see bullish confirmation the next day, which direction should it be going based upon the probabilities that the Japanese race traders have given us? It should be going up. That means if it opens positive, it should trade positive. It shouldn't trade back down below the open of that previous day or the head of the previous day. That would tell us the bears are still there. Get right back out of the position. Recognizing where a signal works effectively is important in the fact that all trends don't start off right away. Notice we had a doji gap up, but the next day we had a bearish harami right back below the T-line. Pulled back a little bit, and then we had an inverted hammer, and then a hammer signal. The hammer signal being confirmed with another close back up above the T-line, basically called or causing what we call a stutter step. The bulls step in, the bears have been happy, now they're concerned, the bulls have stepped in, but the bears are happy because the price gets knocked back down. The next time that you see a buy signal, in this case a hammer, with bullish confirmation, the bears say, shoot, the bulls are back here again, get me out of the way, and that starts your strong uptrend. But notice the tail to the downside. That gives you the neon sign to say, start looking for a buy signal after that hammer. A gap down in an oversold condition, start looking for a buy signal. If that buy signal turns out to be a hammer type signal, look for bullish confirmation the next day. You can be buying immediately. This gap down tells you that's the exhaustion of the sellers, and they finally found a place of equilibrium where the bulls are now stepping in. Where do most people sell? They panic sell at the bottom. If you see that gap down in an oversold condition and a hammer, start looking for your bullish confirmation. This, again, is not rocket science. This is just common sense graphics that the Japanese race traders have produced for us to show what goes on in investor sentiment. Plus, if you understand what goes on in most investors' minds, which through the years might have been your own decision-making process. Knowing what these signals are illustrating now turns you around 180 degrees. Instead of being the panic seller at the bottom, you're starting to look for the buy signals at the bottom and get ready to buy. This also gets you through the emotional trauma of listening to all the news and all the negativism out there of whatever you're trading. Where do most people panic sell at the bottom? Let's see. No, that's not the way to say it. Most people panic sell at the bottom. So the question always is, if everybody is panic selling, who's buying at the bottom? And it's usually the smart money. Knowing that most people panic sell at the bottom, witnessing that gap down in an oversold condition should be the alert that tells you to start watching for some sort of candlestick reversal signal. Once you see it, now you can put all the other elements of a good trade in line. 1, how far away are you from the T-line? 2, how's it opening the next day? Then you can see if it's in an uptrend, what type of signal is it creating once it gets to the T-line. A gap down in the oversold area and they do a hammer, that means at some point the bulls have stepped in. Watch for bullish confirmation the next day. In this case, did exactly what it should do, brought it right back up to the T-line. Now at that point, we've got a bullish candle. We've got the benefit of seeing what type of investor sentiment is at that level. In this case, the next day they open up positive and take it in a strong candle through the T-line, which means now you're above the T-line and you can stay with it as long as it doesn't close back below the T-line. And where is it likely to go from here? Up to the first major resistance level, the 50-day moving average. Utilizing the information of that gap down and a candlestick buy signal potential allows you also to take advantage of option trades where at this point not only is the premium but the price of that an option of this on this trading vehicle is probably very low because it's been heading down. There's no enthusiasm in those calls. So this allows you to buy calls at a low price and very low premium built into it, but it expands very quickly once that reversal starts in progress. Gap down, use that information. Gap down, hammer. We're starting to look for bullish confirmation after that, knowing that if it opens positive and trades positive, we don't want to see it close back below the head of this hammer, because if it does, now it's creating another dark candle that tells us this downtrend is still in progress. The fact that they took it up and then gapped it up through the T-line told us the information that we wanted to know. A reversal of a hammer signal after a gap down, bullish confirmation, and now confirmation that the T-line is not going to act as resistance. A little bit more bullish confirmation, and it broke this downtrending channel. We have the benefit of seeing exactly what's going on as far as investor sentiment. This one became a buy potential, even though everybody saw, or most people would have said, oh, all right, this is still down. Why would you know to be ready to buy? This is what exactly the Japanese rice traders have provided for us, is reversal signals that have worked very effectively for the last 400 years. The same information that is built into a gap down at the bottom is also built into a gap up after a hammer at the bottom. That enthusiasm now is going to the bullish side instead of the gap down being the panic selling at the bottom. The strongest uptrends start with a candlestick reversal signal followed by a gap up. The logic behind this is very simple. If these are signals that tell you there's a change of investor sentiment after a strong downtrend, and then they gap it up after that change of investor sentiment, that tells you there's a strong force to get back into this trend or this position, which usually indicates that the follow through is going to be very lengthy. A hammer signal, doji, and a strong gap up. The bigger this gap up, the more power there's going to be in the uptrend. Notice how this gapped up right to the T line and closed above it. You see a setup like this, you want to buy because you have an extremely high probability that the bulls have now taken control, not with just a minor uptrend, but with a strong uptrend with that gap up. In this example, you've got a hammer signal and then a mild little gap up, except for the fact that this is more like a kicker signal where they opened it here and closed it down here and then gapped it up above the previous day's open and went the opposite direction. So you've got a hammer signal and then they gap it up from where they opened it well above, where they closed it the night before, well above where they opened it the day before, and went in the opposite direction. The fact that you've got a kicker signal, hammer, doji, and stochastics in the oversold area start moving up tells you that there's going to be a strong uptrend following this setup. The different logic that is incorporated into candlestick analysis is not what we think is going to go up. That's what a lot of fundamental long-term investors are anticipating, that if they find a company or a trading entity that they think things are going to get better, they want to invest in it. Candlestick analysis does that instantly. It shows you where there's been a change of investor sentiment and that bullish confirmation. In this case, a gap up from a hammer doji, stochastics coming up, a gap up as well as a close above the T line. Once again, this whole setup here shows there's been a strong reversal, which is usually going to be interpreted or implied that uptrend is going to last for a good while. A gap up after a hammer signal and a close above the T line, the probabilities are with you. Again, the whole point of investing is to try to set up your trades or your investment funds into things where the probabilities are greatly in your favor. This type of scenario is that probability put greatly in your favor. Hammer, gap up, close above the T lines, stochastics coming up. And I try to explain in each one of these training sessions that you're seeing a lot of repetitive chart patterns, but remember, candlestick analysis is a visual analysis. The graphic depiction of what's going on in investor sentiment can be seen to work time after time after time. So what we want to do is recognize the criteria for that strong reversal. So that's why we're trying to get the mind's eye trained that if we see a candlestick reversal signal, a potential hammer or a hammer signal, a potential reversal signal, followed by a gap up coming out of the oversold area, that is just a high probability trade that you want to be able to recognize immediately. It's very easy to do scans for candlestick signals in the oversold area. It's also very easy to do scans for candlestick signals in oversold areas followed by a strong price move the next day. This is what's going to provide more trades than you'll ever be able to handle, but each time you get into one of these positions, the probabilities of being in the right position at the right time will be greatly in your favor. Also, the repetitive viewing of these charts is to try to help people that have mental faux pas or phobias. A lot of people overanalyze. They'll see a perfect chart pattern and they just can't pull the trigger to get in it. What we want to do is convince people that if you see these chart patterns, the probabilities are extremely strong that you're going to be in a profitable trade. The worst case scenario is you've got simple parameters. If you see a hammer signal in an oversold condition followed by a gap up and trading above the T line, your stop loss is very simple. You don't want to see it come back down below the T line. So if you have the probabilities of heading higher and a place to set your stop losses so you're not going to have a huge loss if you get into a position, that allows you to pull the trigger a lot faster. Hammer signal, gap up. Strong buy signal. Hammer signal, gap up. Strong buy signal. Also in a pattern. Notice the scoop type pattern. The hammer, or that little tail to the downside, is your neon sign to tell you to start watching for a reversal. The hammer, especially a hammer doji, shows you there's a change of investor sentiment potential. The gap up the next day confirms it. Do you always get a strong uptrend like this after that type of reversal? Not always, but the percentage of that type of trend is so strong, you don't want to disregard it. That's exactly what this type of signal is telling us, is that there's a strong demand to get back into this position, which usually results in a very strong uptrend. There's always the question of, well, what if I buy the next day and it immediately backs off if it opens positive? That can happen. But you got to remember, this is a signal that tells you there's a possible reversal. That even if you buy and it backs off, the fact that you're still looking at a candlestick reversal signal tells you the probabilities eventually this uptrend is going to get started. In this case, they brought it right back up the same day. So remember, the signal is telling you something has changed. There'll be a lot of times where you buy a position and it backs off from where you buy it, but that does not change the information that was conveyed from the signal itself. Indecisive trading at the bottom of a downtrend. Watch for your signals. Another kicker type signal telling you there's been a change of investor sentiment. Confirmation that there was a positive open, gap up. Confirmation that you closed above the T line. Further confirmation, and they took it up again, that you were breaking this downward trend channel, telling you you're probably going to be in a strong wave. The probabilities are so strong after a gap up from a hammer signal that to try to go against it or try to disregard it is not going to create any profits for you. Through the years, every time I was hoping a price would do something or didn't expect a price to do something because we were looking at something that was so obvious that we had a hammer signal and a gap up, that everybody else was watching that too. So if everybody's watching that, it can't work. You got to remember, and this is a question we're often asked, if everybody's doing the signals, doesn't that take away from the efficiency of those signals? The answer to that is 90% of all trades are done on a fundamental basis. 10% of all trades are done on a technical basis. And probably 1/10 of 1/10 of 1/10 of 1/10 of 1% is probably done with candlestick analysis. You got to remember, there's many other technical trading programs out there, whether it's Elliott Wave, Fibonacci numbers, trend channels. There's tons of things. Not everybody has gotten educated yet on candlestick analysis. And that is a shame, because if people would learn how to use candlestick analysis initially, then they wouldn't go through years of using the wrong techniques and the wrong way of thinking. That is why the Japanese rice traders have exposed these signals, because most people sell at the wrong time and most people buy at the wrong time. A hammer gap up. Put that in the same realm as your best friend. The probabilities are going to be that the uptrend is definitely in progress. And this is just common sense analysis provided by Japanese rice traders. That if you see a hammer, indecisive trading, and then they gap it up and take it the other direction, that tells you there's been a decision made. And we can see it very graphically. Any trading element of candlestick analysis is done purely by common sense investment perceptions. When people are selling, people are selling, people are selling, and then it gets indecisive, that means there's probably a change of investor sentiment about ready to occur. And when it does, we can see it graphically. A lot of people, as I've mentioned earlier, need 3, 4, 5, 7 days of a trend reversal before they will jump in. Getting in early has two great benefits. Everybody else that's getting in once it's confirming is adding to your profits, number one. And number two, if it doesn't work, your stop loss is very close. As with all candlestick reversal signals, the stronger the gap up, the higher the probability of strong uptrend. Also, the bigger the tail to the downside and coming back up also is an example of the bulls definitely taking control and starting the trend back up again. Gap up confirmation. Notice the tails to the downside. Spinning top with more of the tail to the downside. Hammer, and then the gap up through the T-line. These tails are definite signs that every time the bears try to knock it down, the bulls have finally found a level to start taking it up, and it's usually when the stochastics are down here in the oversold area. The bigger the signal, the higher the probabilities are that there's been a definite change of investor sentiment. This is true with the hammer signal as well as all other candlestick signals. As illustrated in this chart, we had doji, bullish engulfing signal. And then the final blast of all the sellers got out of the trade and the bulls stepped right back in. This whole conglomeration of reversal signals is now, solidified by the fact that they've gotten rid of all the sellers and now the bulls can step in without any sellers in the way. The bigger this signal is, the more compelling that there's been a change of investor sentiment. The huge tails to the downside is clear evidence that every time the bears try to take it down, the panic selling is involved. Whatever it is, the bulls have stepped back in and brought the price back up again. This case right here, big tails to the downside, tells you you're probably getting in a bottoming area. Another big tail to the downside, and then a kicker type formation here where they've gapped it up above the previous day's open and gone the opposite direction. Again, this whole evaluation is showing you that there is a bottom. Don't get caught up in just trying to find one signal and having it work, and some of them don't work the very first time. You get a big signal, you're still in a bottoming stage, the second signal may be more effective. And not only the bigger the signal, but the bigger the confirmation also tells you there's been a definite change of investor sentiment. Hammer in the oversold area followed by a gap up is first confirmation. Second confirmation is they were taking this up strong. Tells us that now that we're above the T-line, we have a basis for staying in this position as long as it doesn't close back below the T-line. Let the huge signal be your neon sign to say there is a change. Start watching for the reversal. These are always great signals because it tells you during the day there's been a drastic change of investor sentiment and they're bringing it right back up and ready to go the opposite direction. Again, a big tail to the downside. Notice what this one did. The alert would have been that if you were down at the bottom of a trend and they gap it down and start taking it down, if you want to be safe, put a buy stop one tick above where it opened, because if they were able to take it down and have a big dark candle down here, if they could bring it back up through that open, that tells you you're going to have some sort of candlestick signal formed. In this case, a hammer signal. Continue to hold as long as you see there's confirmation the next day. Adding up all the elements of a reversal, big down day, big hammer day, bullish confirmation, occurring right here on a major support level, stochastics turning up, gives all the implications that there's now been a change of investor sentiment. We should be watching to see what they do once they get up to the T-line. And hammers at a support level is very indicative of what's going on in investor sentiment. Remember, all the major money managers around the world use the major moving averages to make their decisions of whether to be in or out of a trade. If it can be seen, notice that this hammer just touched the 50-day moving average and bounced back up. That was a message. Took it down again, but brought it back up above the 50-day moving average. Couldn't get it closed below there. Upon seeing positive trading the next day, that should give you a good clue that when they got down to the 50-day moving average, they kept pumping it back up, and finally there was a reversal. The tails are very indicative of where the price is being taken back down to. Notice here at the 200-day moving average, once they have hit this moving average, somebody's starting to buy. They take it right back up again. And seeing these signals occur right on a 50-day moving average, this is where you come back with a very simple observe the obvious. The obvious is every time they try to take it down through the 50, they're bringing it back up. Stochastics toward the oversold area starting to come back up. Look for bullish confirmation off this level. When everybody else starts seeing that they're not taking it through the 50, that's when they start jumping into a trade also. We have the benefit of seeing that early, knowing what these signals represent, and this allows us to be in a trade, getting on big profits, number one, and number two, if this fails, stop losses are very, very small. The visual aspects of candlestick analysis makes it very easy to see that as they were pulling back toward the 50-day moving average, we had a hammer, and then the trajectory started turning around and going back the opposite direction. Stochastics in the oversold area. This is where everybody's watching to see what happens once it gets back to this level. So it's very simple to explain that where these signals occur have great significance. Right here on a moving average, and then you start seeing the bullish confirmation. Very simple pattern. They move it up, they pull it right back to a major support level. We can see immediately what they're planning to do at those support levels. And the approach to a support level doesn't need to be exact. They took it down through the 50. Huge hammer signal, brought it right back up to the 50. This whole trading right here tells us they're not moving away from the 50. They're staying right here. Then a positive open the next day tells you they're taking it back up through the 50. You want to be a buyer. And support levels don't necessarily have to be moving averages. Notice that we had a bullish Harami right here on this moving average, took it up, brought it back down through the 50-day moving average, but notice what they had right here, a double bottom or a double bottom support when we saw a hammer signal. When we see a hammer signal forming right here, we should be immediately anticipating that this is the level they're going to be supporting at. Start watching for the buy signals the next day. This support level was pretty much indicated by this downtrending bottom. We see a hammer bringing it right back up into the trend range, and then what could be considered a resistance level, when they gap it up through the T-line, tells you that's not acting as a resistance level. And the probabilities are, with the strength of this type of signal, a hammer followed by a gap up through the T-line, that this downtrending channel is probably going to be breached and you're going to be in a strong uptrend. And the hammer signal, like many other of the candlestick signals, can also have duplicate names. It doesn't matter what you name them, they're still the signals. For example, in this reversal, we've got a big down day, doji, hammer day, 2 indecisive trading days, then a gap up third day. This is a Morningstar signal, a double Morningstar signal, but the same aspects of what makes a strong trade, whether you call it a Morningstar signal or a hammer signal followed by a gap up, are the same. The fact that there is an indecisive trading and the last day of the Morningstar signal was a gap up and closed well above the halfway point of this candle and above the T-line tells you there's been a definite change of investor sentiment. Hammer, doji, followed by a gap up bullish candle. Again, a Morningstar type signal. It doesn't matter what you call it. It all has the same implications. A reversal, indecisive trading day, and then a gap up. Going to start in a strong uptrend. Another Morningstar signal. Hammer, gap up. If you cut the chart off right here, this is a strong reversal. The fact that it's also a Morningstar signal gives it that much more credibility. There's been a change of investor sentiment. A hammer type signal. That may mean that your tail isn't quite 2 times as great as the body, but it still has the elements of a hammer signal that just bounced off the support level and then gapped up the next day. Don't get caught with trying to name it something that's going to fit the exact description when it does the same basic thing, that whether you call this a spinning top with a gap up or a hammer type signal with a gap up bouncing off a support level, it still has the same implications. We're starting an uptrend. And the hammer harami is not an uncommon situation where they open it, they take it down one last day, bring it back up, close it as a harami and a hammer signal. Still has the same ramifications, that if they open this positive the next day, especially with it being down toward the lower end of the stochastics, it's time to be buying. Knowing what a hammer signal represents, that the bulls might be taking control, especially in the oversold area, it allows us to anticipate whether this is going to be a good trade the next day or not. And all that requires is a positive open to start the uptrend. Having this ability to recognize where the signal is occurring in the oversold area at the end of a downtrend allows us to prepare for what we want to do the next day as far as our trades or getting into positions. So all we need to see is this type of signal on our scans. We can write it down on our watch list so that the next day, if it opens positive, we can start buying. And it also allows us to have a double combination name, a hammer, bullish engulfing. Once again, when you see them take it down and then they start bringing it back up through the open and do a bullish engulfing as well as a hammer signal, same simple criteria. We're looking for a positive open the next day. Hammer, harami, tells us the selling has stopped and we've had a hammer signal. If it opens a positive the next day, we don't have to be guessing. We don't have to be speculating whether they're going to be taking it up. The probabilities are extremely strong that if you see a hammer, harami, followed by a gap up the next day, they're going to be taking it up. We don't know what the magnitude will be. We just know that if they've gapped it up after this type of signal, that more than likely the trend will be fairly substantial. And anytime a signal has the aspects of a doji, makes it that much more compelling that there's indecisiveness and a change of investor sentiment. A dragonfly doji is your ultimate hammer signal. They open it at the top, take it down, and close it right back at the top. Again, this with stochastics near the lower end of the trading range, look for a positive open the next day. And analyzing the signals is nothing more than analyzing excuse me, the common sense that is applied to these signals. Big down day, doji day, the next day they open up positive, but take it down and bring it back up and do a hammer morning star signal. So basically this signal right here has got that little booster to the downside, and then they've reversed it. More information or more credibility that there's been a change of investor sentiment. Morning star signal with a doji hammer signal followed by a gap up makes this very easy. Closed right on the T-line. We want to be buying if it comes up above the T-line. The next day they open it lower. Very simple entry strategy. This should have told us there was a reversal. Either they've failed at the T-line, we'll be taking it down, or if they open it lower, just put a buy stop one tick above where it closed the night before. If it comes back up through that level, it tells you the bulls are still there and they're taking it back up above the T-line. Tail, not quite 2 times greater than the body, but still has the elements of a hammer signal and a bullish engulfing signal. Still gives us that implication that they took it down and are bringing it back up strong. The positive open the next day confirms that. So now we even got kind of a morning star signal starting with a gap up with a hammer type signal that showed the reversal. And the signals do not have to be solitary. If you start seeing multiple signals, that's when you start anticipating there's going to be a change of investor sentiment. In this case, big hammer signal followed by a bullish harami the next day. After a doji, little shooting star type trading, indecisive. But the combination of all this together, especially down here in the oversold area, tells us start watching for some bullish confirmation, which we saw right after the bullish harami. All the signals, or the 12 major signals, usually require bullish confirmation. But they also give an indication when that change of investor sentiment might be setting up. A doji. Now we have the hammer signal followed with doji above the T-line. Tells us there's been a change of investor sentiment and makes it very simple. You stay with this as long as it doesn't close back below the T-line. The fact that we saw tails to the downside multiple times tells us that this downtrend has finally reached an equilibrium point where the bulls and the bears are fighting, and then eventually it shows the bulls are going to win. The hammer should have given us the neon sign to get ready for the reversal. However, the next day they open it way down here. That's not confirmation. However, by the end of the day, they do a bullish engulfing. So you essentially have kind of a left-right combo. Now you start seeing the combination or the confirmation of this combination of signals. Doji at the bottom, hammer right next to it. Look for positive confirmation after that. This is not rocket science. This is just identifying where looks like there's going to be a change of investor sentiment. Another case of observing the obvious. Every time the bears were knocking this down big, the bulls are stepping right back in. These big tails to the downside are all evidence that the bears are running out of steam, the bulls keep stepping back in, and eventually they're going to sop up all the selling and the uptrend is going to start. So very simply stated, those tails to the downside are merely telling us that the bears are running out of steam and the bulls are now starting to pick up steam. This whole setup down here, downtrend, doji, hammer, look for bullish confirmation, and it's basically confirmed by the fact that your stochastics being in the oversold area are now starting to come back up. That means there is a change of investor sentiment. As with even the doji, a series of dojis represents indecision. They're going to tell you which way they're going to take it after the indecision. Same situation here. Series of hammers with tails to the downside. Eventually, they're going to tell you which way they're planning to take it. And usually, if your stochastics are down here in the oversold area, this is just evidence that the bears can't take it down any further. Well, that pretty well gives you a lot of the elements of what candlestick signals or hammer signal provides. So let's do a quick review on some of the major aspects of a hammer signal. It basically boils down to that if you see a hammer signal, the tail's to the downside, and they gap it up the next day, it's usually the prelude to a very strong uptrend. And that alert is based upon witnessing a gap down in the oversold area. That gap down tells you there's panic selling or people just wanting to bail out as fast as possible. And at the end of the day, if they form a hammer signal, that tells you that probably the bulls have sopped up all the last of the selling and they're about ready to start the trend back up. We also witnessed that if one signal means a change of investor sentiment, a series of those signals like hammers are about ready to change investor sentiment. And then eventually, with confirmation, especially bringing it up through the T-line, tells you that this was the bottom, that your upside now is pretty probable. Does that necessarily mean you're always going to get strong uptrends? Not necessarily, but the benefit of candlestick analysis is that if you're using the signals and they're occurring in the right conditions of a trend, it boils down to very simple analysis. The Japanese rice traders say if you see a candlestick buy signal in an oversold situation, the probabilities are extremely strong. You're about ready to see an uptrend. And the gaps are very friendly for the candlestick investor. Where most money managers say stay away from gaps because you don't know what's going on in the price, gaps and candlestick signals are your best friends. If you see a gap down in an oversold area, start watching for a candlestick buy signal. If you see a candlestick buy signal in an oversold area and they gap it up from there, you definitely want to be a buyer. The more evidence that you can put into your analysis, such as buy signals occurring right at the support level, stochastics in the oversold area, a gap up off the support level after a buy signal, just improves the probabilities of being in the right trade at the right time. A hammer type signal is with the extensive tail to the downside. It can have a little tail to the upside. It still represents the same thing, that they took it down lower and they brought it back and were trading near the top end of the trading range. Hammer signals can be part of other signals, such as a Morningstar type signal. The same elements that make a Morningstar signal strong, which is a gap up on the final day, closing well above the halfway point, can follow a hammer signal or any other decisive trading day. The hammer signal just shows that the force of the sellers are now disappearing. Expect that reversal. The hammer signal is considered one of the 12 major signals because it occurs often enough that you're going to be able to use it probably in a high percentage of your trades. All the 12 major signals occur with good consistency. There's always the question of which one is stronger than the rest of them. They're all the same depending on market conditions. There's going to be times when the markets are producing lots of hammer signals because that's the characteristic of the market at that time. Next month, they may be producing dojis. The following month, at the bottom stage, they may be producing bullish harami. There is no one signal greater than the others other than the kicker signal. They all represent a change of investor sentiment, and they're strong enough that if you consistently use the candlestick signals, you're going to be way ahead of everybody else, both mentally and financially, knowing what the signals are telling you. That's it. We'll see you in the chat rooms. Thank you for listening.